we learned that a portfolio's risk can be described as the sum of two components: the variances of the securities contained in the portfolio and the products of the covariances between securities and their standard deviations. And we are ready to introduce a very important concept. There are two types of investment risk: systematic and unsystematic risk, also known as undiversifiable and diversifiable risk. The first component, the variances of the securities in a portfolio, can be seen as undiversifiable risk. Regardless of the number of securities contained in a portfolio and the relationship between these securities, this component will continue to exist. This is the uncertainty that is characteristic of the entire market. Systematic risk is made of the day-to-day changes in stock prices and is caused by events that affect all companies. A recession of the economy is one systematic risk. Other systematic risks can be unfavorable consumer demand, wars, earthquakes, and all risks capable of affecting all companies in an economy. The uncertainty arising from systematic risk is something we have to accept when investing. Fortunately, a lot can be done about the second component, unsystematic risk, also known as idiosyncratic risk. These are company-specific, even industry-specific, risks that can be smoothed out through diversification. Academic research has shown if we build a portfolio containing at least 25 to 30 stocks that are not correlated, unsystematic risk will almost disappear. It is not a coincidence that many investment funds try to provide their clients with the opportunity to invest in an investment vehicle, like an investment fund that contains the same stocks as the S&P 500 index. If you own a portfolio of 500 stocks, the only risk you are exposed to is systematic risk, and it doesn't mean this comes at the expense of a lower expected return. Some institutional investors go even further and build portfolios of securities not from the same country, which should reduce the correlation between these securities even further and drive down the overall portfolio risk. In the next lesson, we'll try to calculate a portfolio's systematic and unsystematic risk. First, we'll do that for a portfolio of 2 stocks, and then we'll see how the overall portfolio risk changes when we add additional stocks. This is it for now. Thanks for watching.